Good morning, everyone. I hope you're having a wonderful day. Sorry if I'm a couple minutes late here. My meetings have been stacked up and just trying to get through them all. But I hope you're all having a great day and you are enjoying the warming weather. It is sunny outside. Thursday, February 20th, here in Thief River Falls, Minnesota. I think we're above zero already, which is amazing. Yes, 2 degrees. So, 2 degrees. That's warm around these parts compared to the last few days where it's been like negative 40. But anyways, welcome back to another Retired Confidently Facebook Live question Q&A. Weekly Retired Confidently Facebook Live Q&A sessions is a casual way for me to connect and answer your questions at no cost. Even if you are not a client, tune in on Facebook Live to ask questions, comment, or just listen to my weekly conversations about retirement planning. My goal is to provide value to as many good people as possible. If you prefer not to ask questions online during the live session, feel free to message me directly. Either way, I'd love to answer your questions and discuss what's on your mind. There's no pressure to work with me or become a client, whether you join online or message me. My mission is to provide my clients with the highest quality advice and service possible. To maintain this level of care, I limit my practice to 100 active clients at a time, as I have a fiduciary responsibility to each of them. While I cap the number of clients I work with, I'm dedicated to serving as many people as possible by sharing valuable information and answering your questions. That's why these Facebook Live sessions mean so much to me. Please feel free to comment with questions anytime now or during the video. I'd much rather answer your questions than read through articles that may or may not be relevant to you. So please comment with your questions and thoughts. Disclaimer, this content is not legal, tax, or investment advice. Always consult a qualified professional regarding your own situation. And since this is a live session, I may occasionally make a mistake, but I'll do my best not to. With that being said, I'll give you a few moments to comment with your questions that I can address right now. And if I don't receive any, I will try to find an article that provides value to you. But like I said, I would much rather answer your questions than just hopefully find a valuable article. All right, seeing no comments thus far, I'm going to read this article from the kitsis.com, and it is titled Why Health Savings Accounts, or HSAs, aren't always worth the triple tax savings advantage. So this is probably hopefully a valuable article to be reviewed for you, because a lot of people, when it comes to their retirement planning, will, while they're at work, will overfund an HSA with the hopes of using it in retirement and tax efficiently. It does affect many people, but not everyone. So I probably won't highlight the entire thing. I will just include it for you to read at your own if you want to dig more into it. But I'll at least cover the executive summary so you have an idea of what the article could cover for you, and will hopefully prompt some questions or thoughts. So the executive summary is health savings accounts have become an increasingly popular tool for financial advisors and their clients, due in part to the triple tax savings they offer: tax-deductible contributions, tax-free growth, and non-taxable distributions for qualifying expenses. So when you put money into an HSA, it's tax deductible. When the money grows within the HSA, it's tax free. And then when you use the money out of the HSA for qualified medical expenses, it's also tax free. So that's the triple tax savings, which makes them extremely effective when used properly. However, HSAs require individuals to be covered by a high deductible health plan, HDHP, which has trade offs compared to traditional health insurance plans, which means that financial advisors, with their knowledge of clients' personal and financial circumstances, are uniquely positioned to evaluate these trade offs and help clients balance healthcare costs and savings to align with their financial plans. So, what they're saying there is, even though you might get a great tax break from using HSAs and high deductible plans, if your tax break isn't worth the additional cost of the high deductible insurance plan, then it may not be a great plan, which is an overall good example of why financial planning and building a retirement plan should take all of your financial picture into account and build a comprehensive plan and understand how each individual moving part affects the other. Because when we look at one individual part of a plan or tool, whether it's your HSA, your 401k, or your life insurance, or whatever it might be, in a vacuum, if we just look at that tool and how that tool works, it may or may not give us the right decision making when it comes to your overall plan. So this example being an HSA, the triple tax savings sounds fantastic if you just look at that tax efficiency, but it may not work well with your overall plan for you as an individual. So it's important to understand both sides of that story. While While HDHPs are often expected, so high deductible health plans are often expected to come with higher deductibles than traditional plans, these deductibles may be higher than they appear. For instance, HDHP deductibles and out of pocket limits apply only to in network coverage, with out of network care subject to higher maximums. Additionally, HDHPs typically apply deductibles to nearly all medical services except preventative care, unlike traditional health plans that often feature fixed copays for prescriptions, specialist visits, and emergency room care. Many HDHPs also use aggregate deductibles, requiring the entire family deductible to be met before coverage begins for any individual, which can lead to higher out of pocket costs, particularly when one family member incurs most of the expenses. Traditional health plans, on the other hand, often provide features that make them more attractive for individuals with moderate or predictable medical costs. For example, traditional plans often come with separate out of pocket maximums for prescription drugs and other medical services, while HDHPs typically have a unified maximum or offer tiered health networks that provide discounts for specific in network providers. Furthermore, because HSA eligibility requires coverage exclusively under an HDHP, clients nearing Medicare age or those with other disqualifying coverage may need to weigh the benefits of HSA contributions against other health plan options. While the triple tax savings of HSAs is one of their most attractive features, those with traditional health plans can also benefit from tax free premiums, which can result in greater tax savings compared to HDHPs with lower premiums. Clients with traditional plans can also take advantage of flexible spending accounts, FSAs, which allow for tax-free contributions and reimbursements, though unlike HSA, any unused funds remaining in the FSA are forfeited at the end of the plan year. So that's a really important differentiator between an HSA and an FSA. HSAs you can grow and delay usage for, I think, infinite time, basically. Whereas an FSA, whatever you put in this year has to be used this year, or you essentially lose it. Combined with the potential cost savings from lower deductible and total out of pockets, which could be invested in taxable accounts, clients with higher medical expenses and in lower tax brackets may find that traditional health plans offer a better balance of savings and healthcare coverage. Ultimately, while HSAs offer significant tax advantages, advisors can play a key role in helping clients weigh these benefits against the potentially higher costs of HDHPs. By aligning healthcare and financial planning, advisors can demonstrate their ongoing value to their. Okay, so, anyways, so that's the executive summary. The big message there essentially is even though HSAs offer fantastic tax advantages, they force you to use high deductible health plans, and sometimes, depending on your situation, it might actually be worse to have an HSA and high deductible health plan than just paying the extra premium for a traditional plan that has more coverage, due to how the costs work out and things like that. So overall, understand that just because there's a tax advantage, it doesn't mean it's the right choice for you. And understand the value of looking at the big picture of your retirement plan, not just each individual decision being an individual decision. Every decision we make, whether it's your health insurance or your life insurance or your retirement plan, and how we invest that, where we put your investments, the tax planning, the estate planning, the legacy planning, it all has to work together and understand how each decision we make affects the other parts of your plan to truly have a comprehensive plan that's clear, concise, and accurate for your retirement. So with that, I'll put this article. It's pretty in depth, and I know it's probably a lot more in the weeds than most people are interested in. But if you are seriously considering what type of medical insurance you should have, I know that's impacting us right now with ourselves and business. Is, should we buy it individually through the state? Should we get group insurance through our business? If we do group insurance, should we do HSA or should we do a traditional plan? So I know it impacts me, and hopefully it impacts you guys, and it provides you, this conversation provided you value. I will put the link or the article in the comments, and if I receive any questions here in the next couple of seconds, I would be happy to stay on longer and answer them. Otherwise, I will assume that those who are watching are not don't have anything on their mind right now, and I will just say thank you for your time. Thanks for those who stop by live or watch at a later date. I will save and I will post this video and podcast here shortly. And I hope you all have a wonderful day. Please take the time, if you enjoyed this conversation, to share it with a friend and or on your social media page so that I can provide more value to more good people like yourself. And comment with questions or thoughts or message me directly. And at the very least, click the button or follow my page for future retirement planning content and things like that. So thank you guys so much again for your time. I hope you have a wonderful day, and I will look forward to next week's Q&A. Thanks. Bye.